Most business owners in Canada eventually face this question. Should I invest through my corporation or should I take the money out and invest personally? On the surface, it looks simple. Corporate investing gives you the benefit of tax deferral, while personal investing might help you access things like the TFSA. But here's the truth most people don't realize. The choice between corporate and personal investing can mean hundreds of thousands of dollars in difference over your lifetime. Not just in taxes, but in how much wealth you actually keep. So today I'm going to break down the long-term tax implications of both options, when one makes sense more than the other, and traps to avoid. Hey there, I'm David Drummond, founding partner at DLD Financial Group. I'm a CFP, have been in the business since 1999, and on this channel, I help Canadian business owners, professionals, and retirees build tax-smart strategies so they can retire confidently without guesswork. If you find this video helpful, please make sure to like it, subscribe, and leave a comment below. And if you're a business owner who wants a customized strategy, book a time with me using the link in the description. We'll walk you through your numbers in detail. Now let's dive in. Part 1, the difference between corporate and personal investing. When you earn income in a corporation, you generally pay a much lower tax rate on active business income than you would personally. For example, in many provinces, small businesses with income under $500,000 are taxed at between 11 and 13% compared to a personal top rate of 50% or more. That means if your corporation earns $100,000 in profit, after tax, you might have $87,000 left to invest inside the company. If you earn that personally, after top rate taxes, you'd have only about $50,000 left to invest. So the big advantage of corporate investing is tax deferral. You get to start with a much larger base because the initial tax bite is so much smaller. But here's the catch. Eventually, when you pull that money out of the corporation, you will face personal tax. And how you invest in the meantime, inside versus outside the company, affects how much tax you pay along the way. Part 2, how corporate investing gets taxed. Let's look at how investment income is taxed inside a corporation. Number 1, interest income. Interest income is taxed at the highest corporate rate, often over 50%. So if your corporation earns $10,000 in GIC interest, you might lose more than half of that to tax. Number 2, Canadian dividends. Dividends from Canadian public companies receive a refundable tax mechanism. The corporation pays tax up front, but part of it can be refunded when dividends are paid out to you personally. This helps reduce double taxation. Number 3, capital gains. This is where corporate investing shines. Only 50% of capital gains are taxable inside the corporation, and the non-taxable portion goes into something called the capital dividend account, or CDA. That balance can then be paid out to you tax-free. And here's the takeaway. Corporate investing can be very efficient if your strategy is focused on growth and capital gains, but it can be very punishing if your portfolio is focused on fixed income and interest. Part 3, when personal investing comes out ahead. Now let's flip the perspective. Personal investing means you withdraw funds from the corporation, pay tax personally, and then invest with what's left. At first glance, this looks worse. You start with less money because you had to pay personal tax upfront. But here's the hidden advantage. TFSA contributions are only available personally. RRSP contributions and spousal RRSP contributions are also personal, and contributions are tax deductible against your income, almost like a tax-free withdrawal out of your corporation. Investment income personally may be taxed at a lower marginal rate than inside the corporation, depending on your situation. For example, if you invest personally through a TFSA, your money grows completely tax-free. A corporation doesn't have that option. Or if you use an RRSP or spousal RRSP, you get a deduction up front, and that growth is tax deferred until withdrawal, often at a lower rate in retirement. So while corporations let you start with a bigger base, personal investing often gives you access to better tax shelters. Part 4, long-term comparison, a scenario. Let's put this into numbers with a simple example. Suppose you're a business owner in Ontario. You have $100,000 of profit you don't need personally right now. Option A, you leave it inside the corporation. After small business tax, you have $87,000 to invest. Let's say you earn 6% annually in mostly capital gains. After 20 years, your investment could grow to around $280,000 inside the corporation after tax. Or option B, you take it out personally and invest through your TFSA and non-registered account. After personal tax, maybe you're left with $55,000 to invest. If $10,000 goes into your TFSA each year and the rest in a mix of investments, your effective after-tax growth could leave you with around $240,000 after 20 years. So in this case, corporate investing looks slightly better because of the deferral and the capital gains efficiency. But here's the twist. If your portfolio inside the corporation leaned more heavily on interest income, the after-tax return would be far lower and personal investing could come out ahead. And if you're maximizing RSP, spousal RSP, and TFSA personally each year, the personal route often wins out over the long term. Part 5, the hybrid approach, where real tax planning happens. The truth is, this isn't an all or nothing decision. The most effective long-term tax strategies often blend corporate and personal investing. Number 1, max out personal tax shelters first. Always prioritize TFSA and RRSP contributions, since corporations don't get access to those. Number 2, use your corporation for tax deferral and capital gain strategies. Focus on growth-oriented investments inside the company, not interest-heavy ones. Number 3, consider corporate class funds or whole life strategies. These can help reduce the deferred tax inside the corporation even further, especially for business owners looking to transition wealth tax efficiently. Number 4, plan your withdrawals strategically. Instead of just leaving money to pile up inside the corporation forever, plan when and how to extract funds, ideally in the lower tax retirement years or by paying out tax-free capital dividends. This hybrid model is often where we find the biggest tax savings over a lifetime because it uses the strengths of both approaches. So, which is better, corporate or personal investing? The answer is it depends on your goals, your cash flow needs, and your portfolio strategy. I would also say we'd want to keep an eye on net worth and where that's going to go. Corporate investing shines when you don't need the money right away and when you can focus on capital gains, while personal investing shines when you can maximize TFSA and RSP contributions, or when your corporation would otherwise be earning highly taxed interest income. The most tax-efficient strategy usually blends the two, using personal accounts for tax shelters while leveraging the corporation for long-term deferral and strategic growth. If you get this right, you can save yourself hundreds of thousands in taxes over your lifetime. So, if you're a business owner or professional in Canada and you're not sure how to balance corporate versus personal investing, this is exactly the kind of planning we do every day at DLD Financial Group. You can book a time with myself in the link in the description, and we can start to build a clear tax smart strategy that works well for you. And again, if you found this video helpful, please make sure to like the video, subscribe to the channel, and leave a comment. Love to hear more from you on this. Thanks for watching, and I'll see you in the next video.